you both Monica and Sydney, for joining us. As you know, as you may sort of, Monica, I think you've done one of these before, and Sydney, this is your first. But this is a very important topic for us for a number of different reasons. And we wanted to have companies that are as varied as you in this field, in this particular sector, to provide insight from your particular perspectives. So, just to give you some background, I was reading an article that was published by the Kauffman Foundation. And basically, it was an analysis of capital access landscape. And one of the things they found was a surprisingly high percentage of entrepreneurs, more than 83%, do not access bank loans or venture capital. They don't access debt, they don't access equity. And the article went on to sort of point out like how much more challenging that it is for people of color. So the 83% actually pertains to the broader category of businesses or business entrepreneurs. And the people of color, they're saying it's probably a significantly higher number. And it's the same thing for people of women. And the issue is that a lot of businesses have been doing it through bootstrapping, relying on their own personal resources, and primarily savings, credit cards, HELOCs, and the like, where they have it. So what we hope to achieve today, with this particular segment, is to be able to gain a better understanding of debt and equity. And debt, as we know, is, I think most people understand debt being a straight line, bank debt, but you also have, patient capital, which you can probably speak to. And then you have the equity markets, which, the pure form of that is venture capital. So with that said, what I want to do first, before we go much further, is to sort of just introduce both of you, our panelists, both you, Sydney, and Monica. And I will start by just sort of reading Monica's bio, and then we'll go to yours, Sydney. So Monica is managing partner and co-founder of Small Business Community Capital, a private equity and private debt impact fund that invests in small businesses with an emphasis on women and minority founders, as well as investments in low and moderate income communities. She also is the president and CEO of Altura Capital, an investment management firm that specializes in data analytics on emerging and impact managers. Throughout her career, Monica and her companies have received multiple awards and recognitions for their work in building financial capacity in underserved markets and communities. Monica sits on the board of Stanford Latino Business Action Network, where she teaches a webinar on capital, the United States Hispanic Chamber of Commerce, where she chairs the Capital Committee, and the Hispanic Heritage Foundation through its Latinos in Finance Trustee and Financial Education Initiative. In addition, she is a capital advisor of the $1 Billion Roundtable and a participant of the Aspen Latinos in Society initiative. She enjoys finding ways to help her community, women in underserved markets build knowledge bridges and ecosystems to reach their true potential. Monica holds an MBA from Columbia University Business School in New York and a JD from Universidad del Rosario in Bogota, Colombia. And so welcome, Monica.
No, thank you.
Sydney,
pleasure to be here.
Thank you, Monica. So Sydney McLaurin joined Material Impact as a partner in 2020. He focuses primarily on scaling technologies that increase efficiency while reducing demand on environmental resources. Prior to Material Impact, Sydney was general manager at Lime. Shortly after joining the company in 2017, then known as Lime Bike, he launched its first ever operational market. Over the next few years, Sydney launched and managed over 30 markets around the globe, including some of Lime's most successful operations. Before Lime, Sydney spent several years at Siemens, managing the company's industrial computer portfolio in the early days of PC-based control. During this time, leading the IPC business, he scaled revenue in the United States by 4x, working hand in hand with Fortune 500 customers to adopt and scale up innovative technologies. He credits his experience with his decision to pivot and help startups navigate the challenges that accompany disruption. Sydney also brings experience as an associate with several venture firms, including Caper Capital and Qualcomm Ventures. He has a BS in Mechanical Engineering from the University of Florida and an MBA and Master in Environmental Management from Duke University. Sydney calls Jackson, Mississippi home and admits to being an avid hobbyist. Lately, you can find him golfing, enjoying the nearest body of water, and playing the latest tech gadget. So with that, we welcome both of you, Monica and Sydney, and sort of going back to the introduction of the theme of what we're trying to accomplish here. I'm going to present some questions. We sort of have a nice conversational exchange that is focused on really eliciting information that our audience can actually learn from to benefit their businesses. So that said, I'd like each of you to sort of, discuss for a few moments, what was the catalyst behind the formation of your organization and your funds. Telling us a little about, some of the typical profile of businesses that you tend to target. And I will start with you, Monica.
So thank you, Keith, for the invitation today. About your question, a bit of our history and what we do. So Altura was founded back in 2005. And really for us, the passion, the philosophy, the commitment has always been this understanding and realization that capital holds a tremendous amount of power to transform communities. And it holds a tremendous amount of power to help entrepreneurs maximize their potential. And sometimes entrepreneurs, especially if they're, small, diverse, they might not think that that is something out there. So something we do with a lot of enthusiasm is working very closely with educational opportunities and exposure opportunities for our entrepreneurs, so they get to understand how is it that we can add value to them. And the other stakeholder we work very frequently with are corporations and their supplier diversity efforts, so that as we know what they need in terms of products and services now and in the years to come, we can team up with them to provide those solutions. And so we're always looking for this win-win-win opportunity. And we work with a number of organizations that help us build that ecosystem. Our role is to put capital, we're private debt and private equity investors. And we usually work with companies that have at least $1 million in EBITDA and that are looking to double, triple their size in the years ahead. I always say that we're in a business of putting together 4 ingredients. They're always the same 4 ingredients, no matter what we look at. It's finding the right people in the right entities with the right products and services, that we can get the right corporate support, and we give them the right capital structure. So those 4 ingredients, that's our business of putting those together. And of course, we do this thanks to the support, and as we are entrusted as fiduciaries by large institutional investors who give us their capital, so we manage it well. And so we invested in these businesses, we help these businesses grow and thrive, and through that, we deliver returns to our investors. But we believe in the fundamental role we play as impact investors. So we're committed to working in areas of low and moderate income communities, committed to backing diverse entrepreneurs, and to creating high quality jobs, which is also an important part of our DNA. So that, a little bit about our history and what we do and who we do it with.
So before I go back to sort of some follow-up questions, I'd like to give Sydney an opportunity to just give us some background with respect to material impact as well. Sydney?
Yeah, thank you, Keith. And first off, really an honor to be participating in the panel. I really appreciate all the prep your team has put together on the background. And so just want to say thank you starting off. So material impact, we are really focused on being able to, make game-changing opportunities that are based in fundamentally different materials. And so if you look at, the world today, most of the big things that you're seeing that are coming out, even if you go back to like Silicon, for example, right? Silicon Valley, for which the place, most of this entrepreneurship is named. Silicon is still the fundamental thing that has, sparked that actual change. And we see those opportunities across the board, right? We see these, game-changing materials that then can be changed into or incubated or grown into companies that are game-changing for, really all communities. And so we are looking for those types of material innovations to find them as early as we can, and to find teams that can build around those innovations and make them into interesting companies. In terms of the types of folks we work with, for the panel, I will say venture capital is an expensive way to fund a company, right? So I think, certainly in the interest of providing information, right, I think you should think of us as, hey, a really expensive way to fund a company, but there are lots of companies who benefit from what we can provide, and that's why people pay the high price of venture. And so typically those are businesses that have a need for scaling pretty quickly. So understanding the timeline around which they want to scale, understanding that they need specific expertise. So materials-based companies is the largest amount of expertise we provide. But also, companies that are doing heavy engineering things. So I have a background in engineering. All of our partners are very, very technical. And so having people who can work with you through those challenges and help you navigate all the challenges of your intellectual property, of your, business formation, of your teams, of very technical teams, all of those things are things that we can provide and make sure that your company can achieve the scale that you're actually trying to make.
So I'm going to have you hold a thought about the notion of venture capital avenue being an expensive sort of way to fund a company. I want to explore that a little bit more, but before we do that, let me just go back to Monica and ask you something about investing on. So as an SBDC, how do you draw a distinction between how you go about funding transactions, Monica, versus a traditional bank? Like, what are some of the critical differences?
Yeah, so banks are our partners, right? So we work very closely with partners, with banks, some of them invest in our fund, and we are usually on the same, in the capital stack. They play a role and we play a role. Mm-hmm. Where we see a fundamental difference in how we play in that capital stack, in the value we're able to provide, is banks typically will look at history, will look at cash flows, and will look at assets, and are able to provide, based on history and existing assets, a certain amount of liquidity, right? And typically, I think their interest rates will probably be cheaper than what we would be able to provide. So how do we come in? We are looking, and we have flexibility. We can do certain payment plans and interest structures and capital structures where we can provide a certain flexibility. We can do it at a term that is adapted to the needs of the company, and we are looking forward as well. So we're sort of rolling our sleeves and understanding, okay, what are the options of this company? Can we open them some doors with corporate America? Could we help them strengthen this team or operations or technology or whatever it may be? So we're going to come in to add value. The bank is more of a passive lender, right? Think about it as a proactive lender that can help to come and add value. And that also allows us to have a little bit more of a visibility around the future that we can put our capital around. So we usually see, where we can do a $5 million check, a bank will do a $1 million line of financing, but we actually complement each other. And so very frequently, our bank investors, we're inviting them to our deals. When they see a business that they want to lend to, but it actually needs the type of partner that we can be, then they invite us. So it's very complementary capital, ours being more of a partner, proactive, with a little bit more flexibility and a very much of a one-on-one approach, and banks certainly being complementary capital to what we do. So
do you take a subordinated position in transactions and have banks be like a senior lender? Is it something where you come in there, you have the company's like shares, for instance, to secure if you do that, or do you take it in that? Please.
We can be both senior debt and mezzanine, and banks, we can share with banks in a senior position, or we could be mezz. So we could be both. The bank usually is a senior lender only.
Mm-hmm. Okay. So Sydney, let's talk a little bit about how you guys structure your transactions. You talk about your kinds of capital being more suitable for companies that are looking to scale quickly, where presumably there's an opportunity in the market and they sort of want to get their, deploy their services or their products pretty fast to capture the opportunity. So how do you guys sort of, when you go in with a company, thinking about, not private, you think about capital one-on-one, you take a position, ownership position in the company. How does it work in terms of, in addition to providing some of the insight, some of the counsel, the guidance, how does it work in terms of the ownership structure? What kind of decisions, how decisions are made? What kinds of decisions your company gets involved with? And, how does that work, if you can explore it a little bit?
Well, I'd be happy to. So this differs across the industry from, and even firm to firm and even deal to deal, to be quite honest with you. In some deals, we will be very involved, right? So say an early stage deal where we took a board seat, we may be involved to the point where we're helping, make day-to-day decisions almost just because it's so early and we can be helpful there. On the other side, if it's a later, and later for us is just, on the C range, right? So thinking about a C, Series A, Series B, Series C investment deal. If we were at Series C, we're often a little more passive, just because again those firms have more of an investment team, and I'm sorry, an executive team. They have a team in place that's doing the day-to-day leadership. And so in those, we serve as sort of an advisor, check in and think about how we can add value, and we're a partner with them as they're building that company. We also typically co-invest. So, our other co-investors are providing some sort of value as well. And so, especially in those cases, for our deals, we prefer to lead. So we prefer to be a lead investor. And all that means is, that we typically are the ones taking the board seat and sort of, driving the investment vehicle, setting a lot of the terms. But in some, we actually, are not the lead, and in those cases, we're less actively involved in the decisions and in the management. Although we are always available to all of our portfolio companies, and so on a day-to-day basis, that's usually how it works. Somewhere in the gamut of that is where most of, I'd say, if you average it out, where it falls. Of, we attend the board meetings, we check in with them regularly. If there are connections we can provide, if there are things they need help with, we're there to provide them, and we try to think proactively, about what they're going to need in the next step, and then go ahead and provide that.
So that sort of a decision is mostly influenced by the stage of growth that the company is in. How much involvement that you can take on support.
Well, right, and it's also the team, right? I think the team is what drives it more than anything else. So, the easiest way to see that team growth is usually by stage, right? Just because a Series C company is usually more established and team.
Right.
But,
and just to clarify, Series A means it's like tranches of investment. You would have like initial investors that come on early stage is usually A, B is the next set, C is the next set. So as a company, as time goes and more investment flows, it sort of dictates that the company is a little more seasoned by the time you go like C.
That's right. And the one I would put in front of that you'll commonly hear is just Series Seed, which again only just means pre-A, or
right.
A lot of different definitions these days, but let's say it's.
And I think it's interesting, Keith, for the audience, if I may, that Sydney and I play in different areas, right? And although we are both investing in companies, Sydney's more on the venture capital world, and I'm more on the small, lower middle market growth businesses. And so we don't usually speak about Series A, Series B, Series C. That's more of the VC world. But it's interesting. We do have some similarities in the terms that we both add value, right? That we're looking to not only just make a passive investment, take a leadership role, but we will be different capital providers for different types of companies. So I always, I teach a number of courses about what every entrepreneur needs to know about capital. And it's so important for entrepreneurs to understand who will be your right capital provider, right? Because chances are, if I'm the right one, Sydney is not, or vice versa, right? So, but it's interesting to contrast, lots of similarities in terms of structure of capital, but then as we deploy capital, we're in different industries and different, risk reward, different strategies.
So along those lines then, Monica, if you can talk a little bit about, what kinds of horizon that you're looking for? Like, have you guys, you're just looking to sort of exit by getting repaid your principal with interest? If you can discuss the distinctions between that and when you actually take a position, please.
Sure. So we like to think ourselves and design our capital so that we are flexible capital, right? Because although our majority of capital is debt, whether it's senior or mezz, we also are equity investors, and either alongside us independently or alongside co-investors. And we also are putting together the right capital structure for the companies, both debt and equity. And we're looking in terms of the financials of the companies we're looking for companies that have at least $1 million in EBITDA and that have strong, stable historical cash flows. in terms of operations, we want them to be at least 3 years in operations. Now, it could very well be like there's an opportunity of an acquisition, and we're backing a team that has the industry knowledge and it's new to them, but the entity that we're helping them acquire is more than 3 years. In terms of industries, we are industry agnostic, but we do prefer companies that work or can work as suppliers to companies, to large corporations. And so there we have, segments like retail, consumer, healthcare, media and technology, manufacturing, automotive, OEMs, and financial services. We like to invest in the companies that all these industries will be able to utilize that they can act as their suppliers. And we're always, looking for significant industry expertise. We love to, and we prefer to choose women run teams or minority owned management teams. It doesn't necessarily have to be the case for us to invest, but that's something we look for and that we like to support. We're also very committed to high quality job creation. So we're looking for companies where we're going to be able to add that value through, creating or sustaining high quality jobs. And in terms of capital structure, again, we're very flexible, right? We could be senior debt, mezzanine, equity, and, based on what the needs of the company are. And transaction size, we can be standalone anywhere between 1 and 20 or so million, and then we can co-invest alongside a great group of LPs that we have that are ready to co-invest with us.
Yeah, and then Keith, one thing I'll add to that too is one thing Monica said is, is in terms of like risk, right, profile of the business. And so, the criteria you just heard of having, 3 demonstrable years of revenue, for us, a lot of our companies just don't have that, right? They have a technology and a cool idea, and they're sort of going after that, which makes it, inherently more risky. And so, just again, for the audience of like, as you're deciding between types of capital, I think you should think a lot about that risk profile to say like, hey, where are you in terms of that risk profile? And that will help you just think about what types of lenders, what types of investors you're really going after.
All right.
And presumably the risk profile is sort of concomitant with the ask.
The reward.
Yes, with the reward, as we would call it. Yes.
Or with the reward. Now, so then along these lines, so what kinds of, in that case, I mean, obviously, if you're in your particular case where, as sort of, as is different from Monica's situation where they typically kind of know where the company tends to be headed with a certain, objectifiable measures of certainty, relatively speaking. In your case, it could be a guessing game to in many respects. And so what do you guys typically look for in terms of your exit multiples? Is there like a multiple that you guys tend to have in mind? And women tend to have in mind? And also, and I want both you and Monica to address this, what are the specific factors that are really determinant in making these decisions? And in saying that, are there any geographic constraints? How does barriers to entry sort of play into this defensibility of the business over time? Discuss, please.
Yeah. Well, I think most venture investors wouldn't call it a guessing game just yet, but we would. I think where we would look at this is like, I think in the growth stage, right, you have more of a multiple based approach, right? You're thinking of, hey, you're investing a certain amount of money, you're trying to get a multiple. I think for most of our deals, if we're at a point where we're thinking, we have to think of a minimum multiple, it's probably not an opportunity that's interesting to us. Just because, again, we are taking very big swings at very big industries and very big problems. And so inherent in that is a large level of growth and a large level of change in terms of being able to move from Series A to Series B and so forth. And so there tends to be a number that is already large enough that we wouldn't necessarily be saying, hey, if it's under this threshold number, we wouldn't do it. And so, for example, if there was an investment that, we wouldn't have a conversation where we're saying, hey, this investment might get an 8x return, and, it could be a 10x return, and we disagree. And then, we wouldn't do it because we think it's an 8x return. I think for us, we're really just looking at it at saying, is this a transformational business? And if it is, then, our return shouldn't even be in the category of the 8x or the 10x, right? We should be looking at, 15, 20, 30, 40, potentially even in the thousands, right? If it's really transformational. And so I think that's where we're looking at. It's less about, a financial sort of, number that we're trying to apply to it and make sure we can get our money back. If we think we won't, be able to make that real transformation, we wouldn't take a look at it.
So our numbers are a bit different because we are, for example, thinking about 2 times our capital as opposed to 8 to 10. And in contrast with, this fast growth, big markets, we're looking at more stable cash flows. And we do want to look for growth. Don't get me wrong. When we look at mature industries and where there's not going to be an opportunity to transform and grow, we're not going to be as interested. But there is a degree of stability. And I think the key element with us is always alignment. We want to be able to find great entrepreneurs that we can trust, that we know bring industry expertise, bring values and principles similar to ours, because there's going to be good times and bad times, and you want to be able to work with a group that you're going to be working well with. And we're also looking for goods and services that we know corporate America will want, and we're spending the time to do that alignment of, okay, how we know you need this good supplier, but we also need to have the stability of that revenue coming in and the commitment so that we can all win together. So we spend a lot of time in that alignment. And so there's a little bit more of that work of alignment and stability. And, for us, we're looking at doubling or tripling EBITDA in the next 3 to 5 years. For us, that's a great bet. It's a great investment. So,
and
yeah,
this is influenced by your investors. I'm taking it. Each of you, Mark, your investors are probably saying, okay, this is kind of what we're looking for.
Well, I think it's also, we are just different investment strategies for different segments of the market, right? So it's just different. We're on the small, lower middle market, doing, the typical private equity, private debt bet, but with a special flavor, I believe, which is a tremendous amount of commitment to work very closely with the entrepreneur and help them in a very comprehensive way, not just capital, but really aligning ourselves to bring them everything they may need and be supportive with them. And then very especially when it comes to aligning them with the corporate relationships that are going to be their partners in that growth. So that's the recipe, and the type of investors that we find. We have pension funds, banks, insurance companies, corporations, ultra high net worth individuals. That's the type of return that is probably on the high teens, low 20s is the typical type of risk return in the bucket where we exist.
Okay. So and this is for both of you, are there any, so you spoke about the sectors that you have to be in, or the character of the businesses, any geographic constraints or?
We invest around the country and we're industry agnostic. So, we do see some places of largest economic activity, in both coasts, Texas, Midwest. So we do see some pockets of largest economic activity that really, usually mirror the type of companies that we're looking at, but we invest all across the country.
Sydney?
Yeah, we're the same. I think you will see these natural places where you will see people working on hard materials problems. Boston is certainly one of those. It's why the firm is located in Boston. It makes sense in terms of finding deals there. But the cool thing is you'll also find a bunch of that work happening in the West. You'll find it happening in the North, in the South, and even West Coast. West Coast tends to be much more saturated in terms of looking at, you know, early stage deals and that kind of stuff. And so we often will end up investing, I think, mostly East Coast, Midwest, you know, sort of North, sort of in that region. But we also will do deals, and we have done deals on the West Coast, and are totally open to that.
So my final question for you both is just looking at this from the standpoint of the minority business involvement, the minority business community in your sectors. And I know that Monica's fund is, you know, they really do have a mission to try to meet the needs of those companies. If you can talk, you know, I'm going to first go to Monica. If you can talk a little about, number one, some of the challenges that you have faced in getting transactions done, and what, you know, potential entrepreneurs can do to be better prepared, you know, for successful outcome. Just talk about that for a moment, please.
Sure. No, so we live in a very interesting market, right? We're very blessed to have thousands of business opportunities come our way through a wide variety of, you know, bankers, lawyers, industry associations, many entrepreneurs that get to know us through all the education we do. And so they come to us with a vision, right? I want to grow, I want to acquire, I need to transition, I need to expand my business, I need to refinance. And so we're always out there, right, in a very proactive way, trying to intersect with great entrepreneurs and see if we can lean into what they are doing. Some of the challenges on the entrepreneurial side is that at times entrepreneurs might not know how to utilize capital, or might not have the relationships, or might have a negative thought about what a private equity or a private debt fund can do. You know, maybe they'll come in and control, they'll tell me how to do my business. And I think that, you know, maybe because of our DNA of being a private equity and private debt impact fund, we care immensely and we respect immensely what entrepreneurs think and what their vision is. And we want to help them execute on that. But we're also at times getting, you know, oh, we want to do this, and we ask for the deck and we ask for the financials and sort of all these things that ideally are there ready for us to be able to quickly respond to, and they're not there. So I think that, you know, that readiness of entrepreneurs to be able to participate actively in the capital markets to maximize their potential is something that I would want them to continue to do. And I tell you, we deploy resources and we work with many stakeholders, you know, chambers and industry associations, the $1 Billion Roundtable, the National Minority Supplier Diversity Council, a lot of organizations that are vested in training and helping entrepreneurs, you know, become more aware of what's out there and become better prepared. The other side of the business is one that, you know, private equity and private debt has been an old boys club. And so we're kind of new in the block. And so sometimes there's these clusters, right? They already know each other, they co-invest, they share deals, they share best practices, and you're just not part of the club, right? And so my invitation, and we've been privileged, you know, we've always been trying to build networks everywhere. And we've been very blessed to have great partners, you know, including some of the largest private equity funds in this country and their founders who have supported us and who have opened their doors to be co-investors with us, to share best practices. But my invitation to those private equity funds and private debt funds, to my colleagues that don't have diversity in their teams, whether it's an African American or a Latina or an Asian or a woman, I would say find one, because you know what, you're missing a great market. And so I think that we just have to continue to, and we know, you know, the numbers of diverse portfolio managers and diverse partners in private equity and private debt are very rare. And we just need to continue to grow those numbers and invite every private equity and private debt fund in the country to open those doors, and to invite institutional investors, as they're allocating dollars, to ask the question. And I know many do so now, and that helps immensely. And I know there's, you know, entities like the SEC, they're doing a lot of work currently to be able to ask those questions in a systematic way. And I think the industry is poised for growth, because private equity is ultimately a business of human capability, of people, that can do deals, that have that ability. And who would think that the women can't do that or diverse people can't do that? They just haven't sort of been invited to it. And, you know, historically, we haven't been there, but we can be, and we should be, and we can actually create unique and immense value. And that's an economic myth that the country exposes itself to if you don't have diverse talent actively participating in private equity and private debt. So I think it's both an invitation to have people join their teams, invite their teams to be included, diversity is included, and also invite non-diverse private, invite, when you're a non-diverse private equity fund, try and find a diverse private equity fund that you can co-invest with and do business with.
Yep. I think that I definitely co-sign that train of thought. And, you know, along those lines, I was, as you know, and you may be finding out for the first time, Sydney, my specialty area of practice was corporate finance. So I work with a lot of venture capitalists in the 90s and 2000s. And, you know, in this sector, you know, even on the legal side, there weren't a lot of people, and certainly on the money side. You know, so for us, you know, it warms our heart to actually have you both here. But Sydney, in deploying venture capital, I mean, I know how competitive it is in your sector in terms of finding the right deals to put your money behind. So you kind of have to be laser focused on what your mission, you know, tends to be. But what are you seeing in terms of, like, you know, diversity and, you know, in terms of, you know, some of the companies that may, you know, be a fit to what you're doing? What are you seeing now? Is there like, you know, positive movement in the right direction, or in a positive direction, or, you know, what's the lay of the land now in your sector?
Yeah, well, I would say, you know, I think there are two comments I come to mind, you know, in answer to your question. I think the first one is building on what Monica said, this concept of pattern matching. And, you know, if you have people who have seen the same pattern over and over again, and they are pattern matching on people who look like them, and then on patterns that they have seen by other people who look like them, then I think naturally they're going to invest in things that look a certain way, and people who look a certain way, and people who, you know, behave a certain way. And so you know, I think part of the challenge, you know, that you know, Monica was alluding to, and I'll build on, is just, if you have other people who have seen different patterns, then it's possible for you to see other patterns that I think are effective, right? And I think assuming that only one pattern is the one that works, that makes money, I think is a miss by a lot of investment professionals. So I think that's the first thing. And the second thing I'll say is, you know, in our firm, it's actually pretty cool because of the STEM movement, the science, technology, engineering, and math. You know, a lot of minorities got money to pursue hard tech degrees, right? Engineering, physics, science. And so we see a lot of those people coming up with innovative ideas, coming up with hard tech ideas, probably at a higher rate, you know, than we see in other sectors, just because there's been so much money, you know, spent on, hey, you should get an engineering degree. You know, I was a product of that, right? So, you know, when I went to school, one of the things, you know, that I had was a ton of support in doing a really rigorous engineering program. And so that is often the case in a lot of these cases where, you know, well, often it hasn't caught up in computer science yet, I would say. So it's catching up. It's really, really close. And we're now seeing the results of that. But even, you know, while a lot of people were doing computer science, I mean, it was, you know, a lot of minorities were getting support in science, technology, engineering, and math. And so we do find diverse engineers working on those, diverse entrepreneurs working on those problems. You know, if you look at our portfolio, you know, we don't necessarily go out saying, hey, we're only investing in diverse companies. But if you look at our portfolio, it is very diverse, right? It is, you know, we have several women founders. We have people working on problems, you know, for women's health. We have people working on problems for the future of energy, for space travel, for the future of food. And so, you know, working on these large, very complex problems, I think is something where, you know, people who have those problems, I think are really, really motivated to do so. Right. One of the reasons I really like working on environmental issues is, minorities, tend to be the first affected and most affected for environmental issues, right? When you think about, hey, where is the environmental pollution, right? It's probably where the poor people live, which is probably where the minorities live, right? That is just sort of facts of life. And so I think, I think the motivation to solve those challenges is very high in minority communities, and putting that together with this sort of concept of having people who are very, very much, working on science and math and motivated to do those things. And then putting that together with this concept of looking for patterns that are not necessarily the same patterns. We actually find a lot of success in building a very diverse portfolio in a way that is not necessarily, exclusionary or not missing out on opportunities for capital, but we feel positions us in a way that we are not only competitive, but better than most funds. But, I don't think anybody's fund thinks it's worse than anybody's. So take that the way it will.
Well, thank you. Well, that's a high note to actually conclude this on, because, it's good to hear that the efforts in STEM programs in minority and diverse communities is actually yielding results. That's really a joy to hear. And so on that note, I will thank you both for agreeing to participate in this on this panel. This is the last of our series for this year. But every year we do have at least one access to capital program that we do tend to host. And but I want to thank you both, because I think that this was very valuable information. And what I want to do is encourage our attendees to reach out. If you have questions, feel free to reach out to both Monica and Sydney. If you think that you may be a fit for something that they're doing, certainly they are not shy about taking phone calls or hearing what you have to say, hearing what you have to pitch. So I want to encourage you, don't, certainly, visit our website. You can find their information there as well. You can find it on flyers. You can find it as well in newsletters. But certainly feel free to reach out. And thank you both again. We appreciate your agreeing to do this, and we look forward to a continued relationship with you both.
Thank you, Keith, and thank you to your council for all the support. You guys have always been wonderful. You're, sharing thoughts with us, sending us opportunities, and we value immensely the relationship. And thank you for inviting us to be here today.
You're most welcome.
Yeah, thank you, Keith, and thank you, Monica. I think this was it was fun to do a panel with you, and I appreciate your insights, and I appreciated sort of listening to your thoughts, and it was an honor to be here today. So thank you, Keith, and thank you to the team.
Likewise.
Thank you again, guys.
All the best. Take care.
Cheers.